Title: Unveiling Washington, D.C., The Future of Finance and AI. Introduction.
Welcome to another electrifying episode of Finance Frontier AI, where finance meets the future. I'm Sophia, and with me is the ever-insightful Max Vanguard. Today, we're coming to you live from the heart of Washington, D.C., right between the iconic Capitol building and the Washington Monument. We've got a power-packed lineup of hot topics, from surging consumer confidence and GDP shifts to groundbreaking innovations in AI and finance. If you're ready to dive deep into the trends that are shaping our financial world, you're in the right place. Let's ignite this journey and get into this week's most viral news.
Absolutely. It's fantastic to be here in D.C., where the energy is as high as our excitement. This week, we're dissecting pivotal updates that could redefine your financial strategies, from fresh economic forecasts to revolutionary trading practices. Stay with us as we break down these crucial stories and give you the insights you need to stay ahead in this fast-evolving financial landscape. Hit that share button and let's make this conversation go viral.
And don't forget, we're also diving into the recent buzz around AI-driven economic indicators. Imagine a platform that uses AI to analyze trends and forecast movements, giving you a crystal-clear view of the economic landscape. Whether you're an investor, policymaker, or just a curious mind, this episode has something for everyone. We'll be exploring how AI is revolutionizing sectors from finance to healthcare, and even education. Plus, we'll discuss the latest in AI ethics and regulatory measures, aimed at ensuring transparency and fairness.
Exactly, Sophia. We'll also delve into some recent, eye-opening news stories. Did you hear about the significant increase in U.S. consumer confidence? Or the surprising slowdown in GDP growth? We'll break down what these numbers mean for you and your investments. And let's not forget the rising mortgage rates. How will they impact the housing market and your ability to buy a home? We've got all the answers.
That's right, Max. And we're not stopping there. We'll discuss the implications of new regulations proposed by the FCC requiring the disclosure of AI-generated content in political ads. Imagine the impact this could have on future elections and public trust. Plus, we have exciting updates on companies like Bolster, which just raised $14 million to enhance their phishing prevention tools, and DeepL, which secured $300 million to expand their AI translation services.
And let's not forget the innovative uses of AI in the advertising world. TikTok is now leveraging generative AI to create more engaging ads. This is a game changer for digital marketing, and we'll tell you why. So buckle up, because today's episode is packed with insights that you won't want to miss.
So whether you're commuting at the gym or just relaxing at home, stay with us for a comprehensive deep dive into the latest in finance and AI. Subscribe, share, and let's embark on this journey together. Welcome to Finance Frontier AI, where we navigate the future of finance with the power of AI.
Chapter 1, Top News of the Week.
Let's dive into this week's top news. Our first story highlights the significant rebound in U.S. consumer confidence.
On May 28, 2024, the Conference Board's Consumer Confidence Index rose to 102.0, exceeding the forecast of 96.0 and improving from 97.5 in April. This rebound follows 3 consecutive months of decline, indicating a boost in consumer sentiment. The Present Situation Index, reflecting consumers' assessment of current business and labor market conditions, increased to 143.1 from 140.6. The Expectations Index, which gauges short-term outlooks, rose to 74.6 from 68.8. This uptick in confidence suggests that consumers feel more optimistic about the economy despite ongoing concerns about inflation and potential recession risks.
The rebound in consumer confidence can be attributed to several factors, including a robust labor market, increased consumer spending, and positive economic news. Historically, similar rebounds have led to increased retail sales and greater economic activity, as consumers become more willing to spend rather than save. Economists like Diane Swank have noted that such rebounds can signal a turning point in economic cycles, potentially leading to sustained growth if other conditions remain favorable. Next, we look at the U.S. GDP growth for Q1 2024, reported on May 30, 2024. The GDP growth was 1.3% quarter-over-quarter, which is below the expected 1.6% and significantly lower than the 3.4% growth observed in the previous quarter. This slowdown reflects potential cooling in economic activity, following a robust performance in late 2023. The lower-than-expected growth rate has raised concerns about the sustainability of the economic recovery and the potential impacts of ongoing restrictive monetary policies.
Analyzing the sectoral contributions to GDP, we see that the services sector, particularly healthcare and finance, continued to grow, albeit at a slower pace. In contrast, manufacturing and construction showed signs of contraction, influenced by rising interest rates and supply chain disruptions. Comparing this with other major economies, such as the Eurozone's 0.8% growth and China's 4.5% growth, the U.S. stands at a crossroads where strategic fiscal and monetary interventions could stabilize growth.
On the same day, initial jobless claims for the week ending May 30 increased slightly to 219,000 from the previous week's 216,000, just above the forecast of 218,000. This marginal rise indicates a stable but cautious labor market environment as the economy continues to adjust to post-pandemic conditions.
Regional variations show that jobless claims increased significantly in states like California and New York, which have large service-based economies heavily impacted by recent tech layoffs. Conversely, states with strong manufacturing bases, like Texas and Ohio, saw decreases in claims. Long-term trends in jobless claims point to a labor market that remains tight but is beginning to show cracks under economic pressures, necessitating careful monitoring by policymakers.
Also on May 30, crude oil inventories reported a significant decrease of 1.600 million barrels, contrary to the forecasted increase of 1.825 million barrels. This unexpected drawdown suggests higher than anticipated demand or disruptions in supply, which could impact crude oil prices.
Geopolitical factors, including production cuts by OPEC and sanctions on Russian oil exports, have contributed to the volatility in oil inventories. The significant decrease in U.S. crude inventories could signal a tightening market, potentially leading to higher fuel prices. This scenario underscores the importance of energy policy in maintaining economic stability, as fluctuations in oil prices have far-reaching impacts on transportation and manufacturing costs.
Finally, on May 31, the core PCE price index year-over-year for April remained steady at 2.8%, matching the forecast. Month-over-month, the core PCE price index also met expectations with a 0.3% increase. These consistent inflation metrics suggest stability in price levels despite varying economic pressures. Additionally, the Chicago PMI for May rose to 41.1, exceeding the forecast of 37.9, indicating a rebound in manufacturing activity in the Chicago area.
These economic indicators highlight mixed signals, with consumer confidence rebounding and manufacturing showing signs of improvement, while GDP growth has slowed and initial jobless claims have slightly increased. The consistent inflation metrics suggest stability in price levels despite varying economic pressures. Chapter 2: Additional Major News.
Let's delve into some significant updates that have been making waves in the financial world this week.
Goldman Sachs has significantly revised its forecast for the U.S. debt-to-GDP ratio, projecting it to reach 130% by 2034. This is a notable increase from its previous estimate of 97%. The revised forecast raises serious concerns about long-term fiscal sustainability and the potential economic policy impacts of such high debt levels. This increase reflects ongoing government spending and economic challenges that could affect future fiscal policies and economic stability. Economists warn that this growing debt could lead to higher interest rates and reduced fiscal flexibility for future government spending initiatives. The implications of such a high debt-to-GDP ratio are profound, potentially leading to more stringent fiscal policies, increased taxes, and reduced government spending on social programs.
To provide context, the current debt-to-GDP ratio is around 105%, already one of the highest in history, comparable to the levels seen during World War II. The forecasted increase to 130% suggests a continued trajectory of heavy borrowing, driven by factors such as infrastructure spending, social security obligations, and healthcare costs. Economists like Kenneth Raga from Harvard University have highlighted that while high debt levels can be manageable in low-interest rate environments, the eventual rise in interest rates could exacerbate the debt burden, leading to higher debt servicing costs and potential fiscal crises.
It's crucial for policymakers to consider the long-term impacts of these debt levels. While current low interest rates make borrowing more attractive, any significant increase in rates could lead to substantial financial strain. Strategies to manage this debt will need to be a priority for future administrations, balancing between stimulating economic growth and maintaining fiscal responsibility.
A growing number of Americans are withdrawing funds from their 401k retirement accounts due to increasing financial pressures. This trend underscores the broader economic challenges faced by many, including rising living costs and insufficient savings. The need for immediate liquidity is driving this shift, potentially compromising long-term retirement security. Financial advisors caution against this practice, as it can lead to significant penalties and long-term financial instability. This pattern highlights the urgent need for better financial planning and support systems for individuals struggling to meet their immediate financial needs. The increased withdrawals can also have broader economic implications, reducing the overall pool of retirement savings and potentially increasing future dependency on social welfare programs.
This situation is concerning for both individuals and the economy as a whole. Early withdrawals from retirement accounts typically come with hefty penalties and tax implications, eroding the savings that individuals have worked hard to accumulate. Moreover, this trend could have a cascading effect on the market, as large-scale withdrawals could lead to reduced investment in equities and bonds, potentially impacting market stability. There's also a psychological impact. Seeing their retirement savings dwindle can lead to further financial anxiety and reduced consumer confidence.
It's a stark reminder of the importance of financial education and planning. Ensuring that people understand the long-term consequences of such decisions and have access to financial advice can help mitigate these issues. Employers and financial institutions play a critical role in providing resources and support to help individuals navigate these challenging financial landscapes.
The rate for a 30-year fixed-rate mortgage has risen above 7%, significantly impacting housing affordability and the broader housing market. This increase in mortgage rates could deter potential homebuyers and slow down the housing market recovery. The higher rates are often a response to inflation and Federal Reserve policies aimed at controlling economic growth and stabilizing prices. Economists note that these elevated rates could lead to reduced home sales and increased financial strain on existing homeowners with variable rate mortgages. The housing market, a critical component of the economy, may see slower growth as a result of these higher borrowing costs. Historical comparisons reveal that mortgage rates have not been this high since the early 2000s, a period marked by slower home sales and increased financial strain on homeowners.
Furthermore, the impact of rising mortgage rates extends beyond individual homeowners. The construction industry, a significant contributor to GDP, could see reduced activity due to decreased demand for new homes. Additionally, higher mortgage rates can lead to increased rental demand, driving up rental prices and further straining household budgets. This cyclical effect can slow down overall economic growth and reduce consumer spending in other areas.
The broader economic implications are significant. As home affordability declines, fewer people can purchase homes, leading to a slowdown in the real estate market. This can also impact related industries such as home improvement, furniture, and appliances, leading to a ripple effect throughout the economy. Policymakers will need to monitor these developments closely and consider measures to support both homebuyers and the housing market.
The New York Stock Exchange (NYSE) is evaluating the feasibility of moving to round-the-clock trading. This potential shift could significantly impact market dynamics by offering investors more flexibility and potentially increasing market liquidity. However, it also raises concerns about market volatility and the need for robust infrastructure to support continuous trading. Proponents argue that 24-hour trading could attract more international investors and make the NYSE more competitive globally. Critics, however, worry about the increased risk of trading errors and the strain on market participants to keep up with the market round the clock. Historical attempts at extended trading hours have shown mixed results, with some markets seeing increased volatility and lower liquidity during off-peak hours. The move towards 24-hour trading aligns with the globalization of financial markets, where investors across different time zones seek access to trading opportunities. However, implementing such a system would require significant technological upgrades to ensure seamless operations and prevent issues like system overloads and increased susceptibility to cyber attacks. Additionally, regulatory frameworks would need to be adapted to monitor and manage the potential risks associated with continuous trading.
It's a bold move that could revolutionize trading as we know it. While the benefits of increased accessibility and potential liquidity are clear, the challenges cannot be overlooked. Ensuring the stability and security of the trading platform will be paramount. Moreover, the impact on traders' well-being, given the demand for round-the-clock attention to the markets, will need careful consideration. The evolution of trading practices must balance innovation with sustainability and security. Chapter 3: Significant Developments.
Now, let's explore some of the significant developments that have been making headlines.
Meta's new AI Council has faced criticism for its lack of diversity, as it is composed entirely of white men. This has sparked discussions about representation and inclusivity in tech leadership. The controversy highlights ongoing challenges in achieving diversity in the tech industry, which can impact innovation and organizational culture. Critics argue that diverse teams are essential for fostering creativity and addressing a broader range of issues, while supporters of the current council structure may focus on the expertise and experience of its members.
This criticism comes amid broader industry efforts to address diversity and inclusion. Studies have shown that diverse teams perform better and are more innovative. For instance, a McKinsey report found that companies in the top quartile for gender diversity on executive teams were 21% more likely to outperform on profitability. Similarly, those in the top quartile for ethnic diversity were 33% more likely to have industry-leading profitability. These statistics underscore the potential benefits of diversity, which Meta's council seems to lack, raising concerns about its ability to address a wide array of challenges and perspectives effectively.
The FCC has proposed new regulations requiring the disclosure of AI-generated content and political advertisements. This move aims to enhance transparency and prevent misinformation in the political arena. The proposal reflects growing concerns about the potential misuse of AI in influencing public opinion and the integrity of democratic processes. If implemented, these regulations could significantly impact how political campaigns are conducted, ensuring that voters are aware of when AI technologies are being used to shape their perceptions.
The rise of deepfakes and AI-generated content has intensified the urgency for such regulations. According to a study by the Massachusetts Institute of Technology, false news stories are 70% more likely to be retweeted than true stories, and AI technologies can exacerbate this issue by generating highly convincing yet misleading content. By mandating disclosure, the FCC aims to curb the spread of misinformation, fostering a more informed electorate, and protecting the democratic process.
DeepL, an AI language translation startup, has secured $300 million in funding to expand its B2B services. This funding underscores the growing demand for AI in global communication and the importance of accurate and efficient translation services in an increasingly interconnected world. DeepL's advancements could significantly impact international business and cross-cultural communication, making it easier for companies to operate globally. The company's AI-powered translation tools are praised for their accuracy and efficiency, setting new standards in the industry.
DeepL's technology is particularly notable for its ability to handle nuanced language translation with a high degree of accuracy. This is crucial for businesses operating across different linguistic and cultural contexts, where miscommunications can lead to significant financial and reputational damage. The company's latest funding round, led by investors such as IVP and Bessemer Venture Partners, will enable further development of its AI models and expansion into new markets, positioning DeepL as a key player in the global AI ecosystem.
These developments highlight the rapid evolution of AI and its profound impact on various sectors, from political advertising to global business operations. The ongoing dialogue about diversity in tech leadership and the regulatory measures proposed to manage AI's influence demonstrate the critical need for responsible innovation and inclusive practices.
Adding to these significant updates, there have been some notable advancements and incidents in the AI and finance sectors that warrant our attention. First, let's talk about Truecaller's partnership with Microsoft to enable AI to respond to calls using users' own voices. This innovative feature aims to enhance personalization in customer service, making interactions more efficient and tailored. Truecaller's integration with Microsoft's AI technology showcases how companies are leveraging AI to improve user experiences.
This partnership is a prime example of how AI is being used to personalize and streamline customer interactions. By using AI to mimic users' voices, Truecaller can offer a seamless and intuitive experience, reducing the time spent on call handling and improving customer satisfaction. This technology could be particularly beneficial for businesses with high volumes of customer interactions, such as call centers and customer service departments. Chapter 4, Finance Series, Investing in Different Asset Classes, Part 2 of 13.
Welcome back to the Finance Series, where we continue our deep dive into various asset classes. In our last episode, we provided an overview of the major asset classes. Today, we'll focus specifically on bonds and fixed income securities, crucial components for any diversified portfolio.
Bonds are essentially loans made by investors to borrowers, which can be corporations, municipalities, or governments. When you purchase a bond, you are lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds are often considered safer investments compared to stocks, providing a predictable income stream and lower risk of principal loss.
Understanding the different types of bonds is essential for making informed investment decisions. Government bonds, issued by national governments, are generally the safest investments as they are backed by the government's credit. U.S. Treasury bonds, for instance, offer stability and security, albeit with lower returns. These bonds are considered virtually risk-free, which is why they often serve as a benchmark for other bond types.
Corporate bonds, on the other hand, are issued by companies to raise capital for various purposes such as expanding operations or funding new projects. These bonds offer higher yields compared to government bonds, but come with increased risk. The company's financial health directly impacts its ability to make interest payments and repay the principal, making thorough credit analysis crucial before investing.
Municipal bonds are issued by states, cities, and other local government entities to finance public projects like schools, highways, and hospitals. One of their key attractions is their tax-exempt status, which makes them particularly appealing to investors in higher tax brackets. Municipal bonds can offer a higher after-tax return compared to taxable bonds, enhancing their attractiveness.
When evaluating bonds, credit risk is a primary consideration. This is the possibility that the bond issuer might default on its payments. Credit rating agencies like Moody's, Standard & Poor's, and Fitch provide ratings that help investors assess this risk. Bonds with higher ratings are generally safer but offer lower yields, while lower-rated bonds come with higher yields and greater risk.
Interest rate risk is another crucial factor. Bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices fall and vice versa. This occurs because newer bonds will offer higher yields, making existing bonds with lower yields less attractive. Understanding this dynamic is vital for bond investors, especially in fluctuating interest rate environments.
Incorporating bonds into your investment strategy can provide diversification and reduce overall portfolio volatility. One effective approach is the laddering strategy, where investors purchase bonds with different maturities. This helps manage interest rate risk and provides a steady stream of income as bonds mature at different intervals. For example, a bond ladder might include bonds maturing in 1 year, 3 years, 5 years, and so on, ensuring that part of the portfolio is always coming due and can be reinvested at current interest rates.
Another strategy is the barbell approach, which involves investing in short-term and long-term bonds. This balances the need for liquidity with the desire for higher yields from long-term bonds. This method can also help manage the impact of interest rate changes on your portfolio. By holding short-term bonds, investors have the flexibility to reinvest in higher-yielding bonds if interest rates rise, while the long-term bonds provide higher income if rates fall.
Bonds and fixed-income securities play a vital role in creating a balanced and diversified investment portfolio. They offer stability and predictability, making them a valuable addition, especially for those nearing retirement or seeking to preserve capital. Understanding the different types of bonds and their associated risks is key to making informed investment decisions.
Additionally, recent trends in the bond market have shown an increasing interest in green bonds and sustainability-linked bonds. These are bonds specifically designed to finance projects that have positive environmental impacts. With the growing focus on ESG, environmental, social, and governance criteria, green bonds have gained popularity among investors looking to align their portfolios with their values. The market for green bonds has been expanding rapidly, with major corporations and governments issuing these instruments to fund renewable energy projects, sustainable infrastructure, and more.
Green bonds not only offer the benefits of traditional bonds, but also provide an opportunity to contribute to sustainable development. Investors are increasingly considering the environmental and social impact of their investments, and green bonds offer a way to support initiatives that address climate change and promote sustainability. As the market for green bonds continues to grow, it presents new opportunities for investors to diversify their portfolios while making a positive impact on the environment. Chapter 5, AI Series, ChatGPT Series, Part 2 of 8.
Welcome to Chapter 5 of our AI series. In this multi-part series, we're exploring the fascinating world of ChatGPT and its wide-ranging applications. Last time, we covered the basics and some initial use cases. Today, we'll dive deeper into more advanced applications and discuss how ChatGPT is transforming various industries.
ChatGPT, developed by OpenAI, is a powerful language model that can understand and generate human-like text based on the input it receives. Its versatility has led to its adoption in numerous fields, from customer service to content creation, and even in complex areas like legal and medical advice.
One of the most impactful applications of ChatGPT is in customer service. Companies are leveraging ChatGPT to enhance their customer support systems. By automating responses to common queries, businesses can provide faster and more efficient service, reducing the workload on human agents and improving customer satisfaction. For example, airlines use ChatGPT to handle booking changes and flight status inquiries, while e-commerce platforms use it to manage order tracking and returns. This technology can understand and process natural language inputs from customers, providing them with accurate and timely responses.
In content creation, ChatGPT is revolutionizing the way we produce written material. It can assist in drafting articles, generating marketing copy, and even creating personalized content for social media. This is particularly beneficial for small businesses and individual creators who may not have the resources to hire a full-time writer. By using ChatGPT, they can produce high-quality content quickly and at a lower cost. Furthermore, ChatGPT's ability to understand context and generate coherent and engaging text makes it a valuable tool for enhancing creativity and productivity in content creation.
The legal field is another area where ChatGPT is making significant strides. Legal professionals use it to draft documents, review contracts, and conduct legal research. By automating these time-consuming tasks, lawyers can focus on more complex and strategic aspects of their work. Additionally, ChatGPT can help make legal services more accessible to the general public by providing preliminary legal advice and answering basic legal questions. This can be particularly useful for individuals who cannot afford legal representation, as they can get initial guidance on their legal issues.
In healthcare, ChatGPT assists medical professionals by providing information on medical conditions, treatment options, and drug interactions. It can also help in drafting patient reports and managing administrative tasks. This allows healthcare providers to spend more time with their patients and less time on paperwork. Additionally, ChatGPT's ability to process and analyze large amounts of medical data can help in identifying patterns and making more accurate diagnoses, thereby improving patient care.
Education is yet another sector benefiting from ChatGPT. Educators use it to develop interactive learning materials, create practice exercises, and provide instant feedback to students. This enhances the learning experience and allows for more personalized education. For instance, language teachers can use ChatGPT to practice conversational skills with students, providing immediate corrections and suggestions. This can help students improve their language skills more effectively and efficiently.
The potential applications of ChatGPT are vast, and we are only beginning to scratch the surface. As the technology continues to evolve, we can expect even more innovative uses to emerge, further transforming how we work and live. From improving customer service and content creation to enhancing legal services and healthcare, ChatGPT is proving to be a game changer across various industries. Innovative business idea, AI-driven economic indicator analysis platform.
Our innovative business idea for today is an AI-driven economic indicator analysis platform. This advanced platform leverages artificial intelligence to provide real-time insights and analysis on key economic indicators. It is designed to offer detailed analytics and predictive insights for significant economic metrics, aiding investors, policymakers, and financial analysts in making informed decisions.
The platform will feature real-time data aggregation from various sources to provide up-to-date information on crucial economic indicators such as GDP, QOQ, Core PCE Price Index, YOY, CB Consumer Confidence, Initial Jobless Claims, Core PCE Price Index, MOM, Chicago PMI, and Crude Oil Inventories.
AI-powered analytics will be utilized to analyze trends, forecast future movements, and identify correlations between different economic indicators. Users will have access to interactive dashboards that display real-time data, historical trends, and predictive analytics, with customizable views to focus on specific indicators or sectors.
Additionally, the platform will offer scenario analysis tools that allow users to create and analyze different economic scenarios. For example, users can input hypothetical changes in GDP or consumer confidence to see projected impacts on other indicators and overall economic health.
Automated reports and alerts will be generated to summarize key insights and trends, with notifications for significant changes or anomalies in economic data. The platform will also include a library of educational resources to help users understand how to interpret various economic indicators and use the platform effectively. Max, this sounds like a highly valuable tool for financial analysts and policymakers. How can this AI-driven economic indicator analysis platform be implemented effectively?
Implementation involves several key steps. First, conduct comprehensive market research to understand the needs of target users, such as investors, policymakers, and financial analysts. Identify gaps in current economic analysis tools and opportunities for AI-driven solutions. Next, assemble a team of AI specialists, economists, and software developers to build the platform. Focus on creating a user-friendly interface that offers seamless navigation and interactive data visualization. Develop robust AI algorithms to analyze economic data, predict trends, and generate insights. Ensure the platform can handle large datasets and provide accurate, real-time analysis. Collaborate with data providers to integrate reliable and up-to-date economic data sources. Launch a beta version to a select group of users to gather feedback on functionality, content quality, and user experience. Make necessary adjustments based on this feedback to improve the platform before a full launch. Develop a marketing strategy to promote the platform, highlighting its unique features and benefits through financial conferences, webinars, and partnerships with financial institutions and government agencies. Regularly update the platform with new data, features, and tools based on user feedback and market developments. Provide ongoing support and training to ensure users maximize the platform's potential.
What measures can be taken to ensure the platform remains engaging and effective for users?
To keep the platform engaging and effective, incorporate interactive elements such as customizable dashboards, real-time alerts, and scenario analysis tools. Provide instant feedback on data queries and analysis to help users understand economic trends and make informed decisions. Regularly update the content and features to reflect the latest economic trends and user feedback. Encourage users to participate in webinars and live Q&A sessions with economic experts to gain deeper insights and direct interaction opportunities. Offer continuous education through a library of resources and tutorials to enhance users' understanding of economic indicators and their implications.
How can we ensure the platform's security and user data privacy?
Ensuring security and privacy involves several steps. Implement robust encryption methods for data storage and transmission to protect sensitive user information. Use multi-factor authentication to secure user accounts and prevent unauthorized access. Adhere to relevant data protection regulations, such as GDPR and CCPA, to ensure legal compliance and build user trust. Conduct regular security audits to identify and address vulnerabilities in the platform. Clearly communicate how user data is collected, used, and protected. Provide users with control over their data, including options to access, modify, or delete their information.
This platform has tremendous potential to enhance economic analysis and empower users to make informed decisions. Thank you, Max, for sharing this innovative business idea.
Stay connected.
As we wrap up today's insightful exploration of AI in finance, let's delve into the unique artworks that accompany our discussions. Max, there's more to these artworks than meets the eye, isn't there?
Absolutely. Our luxury conceptual digital art is not just a feast for the eyes, it's crafted with potential investment value in mind. Each piece is inspired by and linked to a specific chapter in our podcast, creating a unique narrative context that enhances its appeal. Drawing inspiration from the trajectory of Andy Warhol's iconic prints, which soared in value over time, we anticipate our artworks could similarly appreciate as digital and AI-influenced art gains broader recognition.
Warhol's work took some time to be fully appreciated, didn't it? How does that relate to our art?
That's right. Initially, Warhol's pop art faced skepticism and was met with mixed reactions. Some of his early works were priced modestly, often sold for a few $100s. Yet, over the years, these same pieces have appreciated enormously in value, with some reaching tens of millions at auctions. For instance, Warhol's 8 Elvises originally sold for $100,000 in the 1960s and later fetched over $100 million. We hope our art follows a similar trajectory, initially niche but growing in significance as the intersection of technology and luxury art becomes more mainstream.
And our listeners play a role in this as well, correct?
Indeed, they do. By engaging with our artwork on social media, especially on Twitter where we frequently post updates, our listeners help determine which pieces we feature. The most popular selections by our listeners are initially offered for sale on Etsy. Looking ahead, we're excited to announce plans for the FinanceFrontierAI 2025 Art Collection, a future marketplace where these artworks will be traded like collector's cards. For truly standout pieces, we'll offer exclusive, limited edition artworks as NFTs, showcasing the best of our annual collections.
So, engagement from our listeners can influence which artworks are available?
Exactly. We encourage everyone to let us know if a particular piece captures their imagination. You can reach out through the contact form linked in our show notes or directly comment on our Twitter posts. This not only helps us gauge which artworks are most popular but also fosters a vibrant community around this innovative blend of art and technology.
For our listeners who want to dive deeper and stay ahead with the latest developments, what do you recommend, Max?
I strongly recommend subscribing to our AI Finance 5 newsletter. It's your weekly summary of the top 5 insights from our podcast, crafted to give you a leading edge in AI and finance. Just fill out the contact form linked in our show notes, and every Friday, you'll receive a concise overview of crucial developments directly in your inbox.
Fantastic! And for those who want to continue this discussion and not miss any of our episodes, where should they go?
To ensure you never miss an episode, subscribe to us on Apple Podcasts or Spotify. Your subscription helps us climb the charts and reach more listeners, expanding our community of tech-savvy investors. Plus, it's the best way to stay updated with our latest episodes and the evolving world of AI and finance.
We also want to hear from you, our valued listeners. Your feedback helps us improve and tailor our content to your interests. Here are a couple of questions we'd love your input on. Would you prefer if we created 2 separate series, one focusing exclusively on AI and another on finance? Or do you enjoy the combined format we currently have? Would you like a series that goes more in-depth on a single hot topic? Or do you prefer episodes like this one, where we cover the most popular news from the past week? Please let us know your thoughts by commenting on our social media posts or through the contact form in our show notes. Thank you to everyone who has joined us on this journey. Your curiosity and engagement are what drive us forward. Stay connected, keep exploring, and together, let's uncover the future of technology and finance.
Disclaimer and acknowledgements. This content is for educational purposes only and is not intended as financial or legal advice. We thank sources such as Bloomberg, Reuters, CNBC, Forbes, Financial Times, The Wall Street Journal, Science Daily, TechCrunch, Investing.com, Artificial Intelligence News, Money.com, Yahoo Finance, Google DeepMind, VentureBeat, AI News, New Scientist, The Verge, The Guardian, CMS Prime, Council on Foreign Relations, The Currency Analytics, TechXplore, Multi-Platform AI, Al Jazeera, Mint, Electric, Engadget, and PIMCO for their contributions to the field, which inspire our discussions. Copyright 2024 Max Vanguard. All rights reserved.